Hi, my name is Carrie Stokes and I run Spotlight Accounting. I've been asked to do a short video on interpreting a set of accounts for a non-financial person. I'm going to try and keep it brief. We haven't prepared these accounts, nor are they a set of accounts that's one of our clients. One of our suppliers have kindly let me use this for this video. So I've got two screens, and the reason I've got two screens is so I can go through the two main financial statements on the left and refer to the notes on the right. So I'm going to delve straight in. I'm going to ignore a lot of the statutory information. That's not because I don't think it's important, it's just not for the purpose of this video. So I'm going to scroll straight down to the first financial statement that you'll find, which is the profit and loss account. The profit and loss account basically shows how much money the business makes. It shows the amount you've sold. It shows the costs that directly relate to that sale. So these are electrical installers. So for example, if we use air conditioning installers as an example, that would be the cost of the actual air conditioning units, and it would be the cost of the labour to install those units. That then gives you a gross profit. From that you deduct all your fixed costs. So these are the costs the business need to incur, whether they get out of bed or not, or whether the installers install any units during that day. From that gives you the profit. So that's how much money the business has made. This differs from cash because, for example, in this situation there's been a vehicle purchased in the year. The vehicle purchase, if they're purchased in cash, if we say for £45,000 and we're writing that off over 5 years, the idea of accounts is that you match income and expenditure. So because that vehicle is being used over 5 years, we write the cost off in the profit and loss account over 5 years. So if we look at the profit and loss account to start off with, the business has increased sales by 130,000, which is great. However, the gross profit has dropped here from 531 to 297,000 pounds. If I then pull up a calculator as an example and take 297,397 divided by 1781442 and times that by 100, they've actually made 17% gross profit in this year. So for every £1,000 worth of air conditioning sales they make, they only have made £166.90 profit. Previous year, if we take 531,087, divide that by 1652963 times 100, last year they made 32.12% profit. So actually the profit on their units has halved this year. Now, with most sets of financial statements, if you scroll to the bottom at the very back, there will be a detailed profit and loss account, and we can see of the £1.4 million worth of cost of sales last year, £1.1 million was direct costs, which the bulk was salaries and subcontractor costs, and £375,000 was the actual materials. The actual material cost has dropped, but the subcontractor cost has increased quite a lot. So the gross profit has fallen because the subcontractor costs have increased. You've got the the fixed costs, so your overheads, your rent, your rates, your motor expenses. Now they've actually dropped from 181 to 116. And if you then scroll through the bottom, you're then looking for the variances, basically, like what expenditure is higher or lower than the previous years. Employee costs have dropped a bit. Motor and travelling costs have increased, which you'd expect. Rent rates, light and heat, the premises costs have remained about the same, but the biggest drop has been in the general admin costs. If we then look here, the biggest drop has been on bad debt. So last year there was a one-off bad debt of £47,000. Now bad debts are where you've invoiced a customer, but for whatever reason they haven't paid you, and you're not going to be able to get that money off the customer. Now again, if you take the £348,000 and add on the £47,000 bad debt, you're almost at a £400,000 profit last year, take into account that one-off against the £155,000 this year. So that highlights even more the impact of the spend on subcontractors on the profit. We then look at legal and professional fees, and again, legal costs have dropped. Now it might be they've had to have legal fees to deal with a dispute from the customer or to deal with that bad debt, but again, it could be a one-off, and that would be what I'm looking for when monitoring the ongoing profitability of the business. So you take your gross profit, which is your sales, less your direct costs, deduct your fixed costs, and then that gives you the profit that the business has made in the year. So in this case, it's 155,000 against 348. You then have your tax bill from that, which gives you the profit for the year after taxation, and that is what goes against your retained profits brought forward as to what can be paid as dividends for the shareholders. So that in brief is the profit and loss account. If we then go to the balance sheet basically shows you the health of the business. So it's a bit like taking a photo of the books at a certain point in time. It shows the stuff, everything it owns, that's the stuff it needs to run the business. So in this case, as an air conditioning installer, it would be the tools, the vans, it could be the unit and the fixtures within the unit that it needs to operate with. You've then got current assets. Current assets are basically everything that could be converted into cash within 1 year. From that, you take away the creditors with 1 year. That's all the money that you owe. So here, if you look at everything you can convert in cash into cash within 1 year, deduct everything that you owe within 1 year, this then shows you what I like to call your bunts money. So this is the working, sometimes the technical term is working capital. So this says basically within 1 year, if you collected all the money that you owed and paid everything out to the people that you owe money to, that is what's left. So obviously the higher that amount is, the better the accounts, because it shows that you can service your debts more. So if we go into the detail on this business, stocks have increased not in proportion with the sales increase. So if we then refer to note 6 in the accounts on the right, you can see here it's work in progress. So work in progress is when you have got contract work, and that's the labour and the material costs at that point in time. So for me, that would indicate there might be some jobs running over that haven't been invoiced, but there's money tied up because you haven't been able to raise the sales invoices to your customers for whatever reason. Debtors are next, and debtors is the money that you're owed and you will collect within 1 year. So that is, if you look in this case, you've got trade debtors of 28 against 204. Again, going back to the work in progress situation, for some reason they've not invoiced the customers. It might be hold up on jobs, you just don't know. You've got other debtors of 113. I'd want to look at why that has increased. And then prepayments. Prepayments, for example, is if you pay for your insurance at month 6 in the year, half of it relates to the following financial year, and accountants make an adjustment so that you're matching income and expenditure in the accounts. The next item in current assets is cash. That's physically what's at your bank. And that then will give you your current assets. So it's everything that you can convert into cash within 1 year. In this case, it's dropped. So again, I'd want to know why that has happened. And then from that, you deduct everything you owe within 1 year. And again, if we look here, the main things to point are bank loan. There's a bank loan and overdraft, which there wasn't last year. Part of that for me would suggest, again, because trade creditors, which is money you owed to suppliers, is a lot less, that they're buying things in advance and paying for them, but the jobs aren't completing as quickly, and that is why the business is in an overdrawn position. Then got corporation tax of £195,000. Other taxes and social security have dropped from 94 to 3. Now, I'd want a detailed breakdown of that because that'll be PAYE and VAT. My guess is that's VAT, because if you're not raising invoices to customers and customers aren't paying, you're not collecting the VAT to pay over to HMRC. But if you're incurring costs for stock and subcontractors are VAT registered, you're paying out VAT that needs to be recovered. So because you're paying out more VAT than you owe to HMRC, your liability will, the amount you owe HMRC will be less. And then the only other thing I want to point there is accruals and deferred income. So accruals and deferred income, they're either sales in advance that relate to next year, or they're costs that you incur after date that relate to this year. So for example, subcontractors is a great example. If they've invoiced you in February for January's work, we need to put January work in the set of accounts so that the profit and loss is showing a true picture for the period. That then gives you your net current assets, which, like I've said, is your bunts money. That tells you how well you can service your debts, how much working capital is in the business. It's good that it's still positive. It's not great that it's dropped, but it's not an area of significant concern, because basically everything that they're owed or that they can convert into cash within 1 year is less than the money that they owe out. That is still showing a healthy business. Not an ideal situation, but it's still okay. You then add on your fixed assets and then deduct your loans after 1 year. So again, if we look here, they've got other loans. If I was looking at these accounts and looking to finance, I would want to look at what those loans relate to. That then gives you what the balancing figure is, which is 7,768. And what that figure basically means, if you sold all the assets for the value they are on the accounts, you collected all the money in from what you owed, all the work in progress was billed to your customers, and you paid off all your loans, money to HMRC and your creditors, you'd be left with 7,768. So again, the higher that value is, the better, is the honest answer. The other note that just to look at from an interpretation point of view is dividends. If you look at the dividends in the year, there was 129,250 taken this year and 278,800 last year. If you look at your profit before tax, they've basically taken all the money they've made this year out as dividends. Now that's fine if there's enough working capital in the business, it's no problem to do that. But again, for me, if they had taken £140,000 but only made 130, there's a £10,000 deficit. So again, that just shows a bit of an amber flag when looking at the accounts. So that is the main points that I wanted to go through. So in summary, the profit and loss account basically shows you how much money you have made in the period, how well the business has performed, has it made money, and then the balance sheet shows you how much the business owns of the stuff they've got. So we'll go through it again. The fixed assets is the stuff you own to make the sales. The current assets is the stuff that you're owed within the business, or the things that you can convert into cash. Then if you take away all the money you owe on that, that shows you how much of the business the shareholders own. I hope that helps. The next video I'm going to do is on a tool that we've got to decipher the accounts, but any questions, please let me know.